Hi everyone, Joe Gentili from Left Tail Risk Advisors. Today I want to go through an important topic for foreign nationals who do not live in the United States and their decision about how to structure the purchase of property in the United States. So, as I've mentioned in previous videos, I have years of experience working with immigrants or non-immigrants that are investors in the United States on various issues related to their investments. So these are topics that I see people don't necessarily think through completely before they invest in the United States. And so it's something I really, really strongly suggest you give serious thought before investing in the United States. So a lot of people want to own property in the United States for a whole host of reasons. They have family here. They see this as a safe place to park money. Lots of reasons. Structure, how you structure it is very important because the tax implications of owning property in the United States are complex. There's income tax issues to concern yourself with, both on the federal and state level, and there's estate taxes and gift taxes to concern yourself with, both on the federal and state level. And how you structure this ownership has a really meaningful impact on how those taxes are levied and how much you're paying. So traditionally, there's two ways to deal with this. So the first way is what's called foreign setting up a foreign blocker corporation. So what's frequently recommended by cross-border tax professionals is that if you're going to buy property in the United States, you set up a corporation outside of the United States. That corporation owns the property instead of you. And one of the main benefits of that is that U.S. estate taxes will not be levied on your death. And this is important because estate taxes for foreign nationals that don't live in the United States, there's very, very little exemption. It's only $60,000 exemption. All the value over that is taxed. Federal level, it's 40%, and it could be more depending on the state you're in. So that is a very meaningful benefit to have the U.S. estate tax not kick in if you have a foreign blocker. Some other benefits of that could be anonymity of ownership. It could be um, creditor protection. So those are some of the main benefits of the setup, but this has real drawbacks. The drawbacks of this are this is a very complex structure to set up. So you're going to have to involve um, tax and legal professionals in multiple countries to set this up. Every year that you own this property, there's going to be ongoing reporting and maintenance requirements for this setup, and that has a cost as well because you're going to have to pay these professionals every year to do that. And your trading taxes. So yes, you're effectively dealing with the estate tax, but what you're doing is introducing additional income tax requirements as a trade-off. So every year you could be paying income tax on this property, additional income taxes for having a corporate structure. There could be additional income taxes upon exiting the property if you're taking the money outside of the U.S. There's a law called FIRPTA that imposes additional withholding and tax requirements for people that use this structure. And you don't get a step up in basis on death. So what that means in simple terms is, let's say you buy the property for $2 million and you sell it for 12. I'm sorry, at death it's valued at 12, and then after you die, your family sells it. They have to pay capital gains tax on the difference between the 2 and 12. So they have to pay capital gains tax on that $10 million. And also, this is very complex to undo. So if you buy the property, assuming a certain set of life life circumstances and that changes, then to undo this or change it is burdensome. So if you decide, you know what, I want to move to the United States permanently at some point, you want to undo this because it's unnecessarily complicated at that point, difficult to undo. The other side of the ledger is that you could own the property in your personal name or probably more commonly in a US LLC, and you will be subject to US estate taxes if you do that. When people set up this structure intentionally, usually they're using life insurance as a hedge for that. So what the life insurance allows, because US life insurance, when you have a death benefit, that death benefit passes income tax free. And if you're a non-domiciled foreign resident, it also passes estate tax free. So that is an effective hedge on the estate tax. You can effectively pay that estate tax in advance using life insurance for a fraction of the cost of the estate tax. So the premiums in the life insurance policy could work out to pennies on the dollar compared to what the estate tax could cost. So they have that. You still, with the LLC, you could still get a degree of creditor protection and you could still get a degree of anonymity. So that is preserved. You're able, you're able at that point to avoid some of the income tax complications that exist with having the foreign blocker set up. So you're not going to have that layer of corporate income tax to pay. There's no branch taxes to pay. So the income tax side of the ledger is much simpler and much less to potentially pay with having the ownership be personal or through a U.S. LLC. You do get a step up in basis on death with this structure, which is very important. So again, going back to that example, you bought a property for $2 million, at death it's worth 12. Now, if your family turns around and sells the property after death, their basis in the property is not the 2 million, which caused $10 million in capital gains taxes with the foreign blocker ownership, but it's the 12 million where there will be no capital gains tax. There's also a lot more flexibility with this because it's a much simpler setup. And along with that simplicity comes with a lot less professional service fees that have to be paid to set it up and maintain it. So I don't think there's a clear best answer as to which setup is better in every situation, whether you set up foreign blockers or you own the property directly or through an LLC and then hedge the estate tax with life insurance. There's no clear answer. It really depends on the situation. How long do you intend to hold the property? What does the income tax implications look like already? What state are you in? It'll also depend on your insurability. What's your health and your ability to get life insurance and at what price? But this is what I do think. I do think that it's worthwhile to not just immediately jump to option A or option B if you're planning on buying property, but to map them both out because the answer is going to be different depending on each situation. So I think it makes sense that if you're dealing with a attorney or a CPA and you're looking at buying the property, and let's say they're suggesting a foreign blocker setup, I think it makes sense to map out the math of that. What is that going to look like in terms of total cost? What is it going to cost you to set it up? What are the likely income taxes that are going to have to be paid along the way for this? What's the value of a step up in basis going to look like? And then map that against the other side, which is, okay, we own it personally or we own it through a US LLC. Yes, there's going to be estate taxes that are going to be due, but there's going to be life insurance to hedge it. What is that hedge going to cost? So what am I actually going to have to pay out of pocket to cover that estate tax? And then what are the income tax savings that we have for this? What are the savings in terms of less professional service costs for doing this? You map the two out and you see where the math leads you. And the math will probably lead you to a clearer answer. And if it's close, then some people they are okay having the additional complexity in their life if it saves them any money really, and then other people they prefer the simplicity. So both options are potentially viable. It's not clear that there's one that's always better than the other, but what is clear is that if you're planning ahead of buying property in the United States, consider both, run the numbers for both, and then make an informed decision at that point. So I wouldn't just immediately jump to one or the other without considering this. If you've already bought property in the United States, then that's a whole different conversation. This is really meant to address if you're still at that planning stage. So this is a very complex topic, obviously. So if you're considering buying property in the United States and you're consulting with attorneys or CPAs, I encourage you to include a life insurance professional in that mix, somebody that is knowledgeable about this area because they could really be very helpful in terms of getting you a sense of what the life insurance piece is going to cost, and they could really help the CPAs and the attorneys kind of map out the costs side by side so you can make an educated, informed decision as to what approach works best for you. Any questions, please feel free to reach out. And as always, if you like this video, please give it a like, and I encourage you to subscribe for future videos if you found this helpful. Thanks.